Happy Friday, everybody. So we're going to do two things today. One is I'm going to go through my, more traditional looking at Market Monitor, showing you what our local market's doing. But I also pulled up some Federal Reserve information to kind of give a bigger picture of where, the economy is and where the housing market fits in there and debt and everything else. So I'm going to start out with the more traditional, going through our MLS here. So again, this is on Market Monitor. Here's our median sales price. So look at this in, again, this is monthly. So February 2021, we're 11.5% higher than last February. So if we go last February, we were 295. So we're at 329 this February. So remember, when you talk about median, that means half the sales are above 329, half are below. So that's what median means here. So what's interesting though is, remember, a year ago we went down and we went pretty much into shutdown mode. So look at the price. February was actually higher than March, April, May, and even June. That is very non-seasonal, because seasonal, you usually have that increase. February is, and then goes higher in March, April, May, June. It's an increasing trend, whereas last year it was completely flat because we were going to shutdown mode. We lost a lot of contracts. We were not writing that many contracts. So it's going to be very interesting going forward because, as we all know, there's a lot of business happening. This number is going to continue to go up, whereas this was flat last year. Watch the next 3 or 4 months. This number here is going to jump significantly. I mean, 11.5 is pretty high. Wait till the next 3 or 4 months, because this trend is probably still higher, whereas it was flat last year. So those year-over-year comparisons, and this, and in my opinion, this applies nationwide, not just Charleston, is that you're going to see some articles with some massive jumps in house prices year-over-year when you compare it just to that 1 month. So we're not going to follow this trend we did last year. It's going to be a higher trend. Price per square foot. So again, drifting, 9.9%. So that's a higher trend here. This is an interesting one. So we finally hit 100%. So we're at 100% of list price is the median, and keep in mind, this is of original list price. So we're hitting 100%. So the best way to explain that to your buyers or sellers are, half the contracts today are full price or higher, and the other half are negotiating below full price, but half the contracts are full price or higher, which is pretty phenomenal. Now, if I go back in time, you can go back to 05, 06, we were hitting 100%. There's some glitch in the program back here that wasn't letting it go over 100. It wasn't 100 every one of these months. It went over 100. So we're at 100% again right now. So, I mean, it's been 15, 16 years since we were at this level. But basically that 100% means half the sales are happening over full price at the moment. Days on market. So days on market, we're down to 8. So again, median, that means half are selling less than 8. And that number is probably even smaller because, I mean, houses are selling literally in hours. And, it might take 2 or 3 days to gather all the contracts and put it together and get it ratified in MLS. So, this 8 is probably a little bit of a high number. So, what it's telling you is, if you have a house listed and it's more than 8 days, the market's kind of telling you, you might not be at the right price because everything is moving that quickly. And, a year ago, so last February, it was 34 days. Because remember, on a traditional seasonal basis, these months, January and February, are generally slower, and then it speeds up going into the spring and summer. So 8 days on the market. Months of supply. So look at this, 0.8 months of supply. Now I can go back in time, and I know I've done this for everybody before. The lowest we were pre-recession was right around 3. So 3 months is as fast as we got pre-recession. So we're at 0.8. So we're almost 4 times faster than we've ever been. So, anybody who compares it to back then, it's even 4 times faster than it was. I mean, when you have this much demand with this little supply. This is the result of it right here. So 0.8 months of inventory. And again, traditionally, that doesn't go higher in the spring and summer. That traditionally goes lower. So, we've
Anton,
yes.
Excuse me, I have a question about the previous slide on days on market. What's the relevance in using median days on market versus average?
It's just an easier way, because the average, you could have houses that have been on the market for 1,200 days that finally sold, right? And then that's skewing that number, so that you could have one or two bad outliers, and it's, we know it's not 41 days, right? 41 days traditionally would be good, but we know it's not 41 days. The better way to look at it is median, because then you can have an outlier of 1,200 days, and it's giving you a better picture. And you don't have to worry about those few outliers that are really skewing the numbers. So, again, median is half the houses are selling in 8 days or less, and half are more than 8 days. So median's always the more, it takes out the outliers and gives you a better number.
Okay, thank you for
that. So again, months of supply, 0.8, and for those of us that were around in May of 2009, it was 17.4. So, that basically meant 1 out of 17 houses was going to sell that month. Now it's basically every house is going to sell this month. So, it's drastically different. Homes for sale. So look at our drop off, which is still happening. So we're at 16, on February 28th, we were at 1670. So 69% less than a year ago. So look at a year ago, we had 5,400 active listings. We have 1,670 today. So a year ago, if we had a buyer, right, we could put them in our car and show them 3 times as much as we can today. So, that's what's resulting in this quick market of, writing contracts within a day, is because that supply is so low at the same time that the demand is even higher. Now, I want to put that 1670 in perspective too. Pre-recession, the lowest we got was right around 4,000. So that was the lowest point, was 4,000. Now, you fast forward 16 years, how many more people are living in Charleston? So think about that. We have less than half the listings in a much more populated area.
Can I raise a hand? Hello?
Go ahead.
Hey, this is Bill Gattle. I just wanted to make a point that the homes for sale, 1670, I think over 1,000 of them are brand new construction, and a lot of those people are angling for clients directly without us. So we really have only like 570 houses for sale.
Yeah, if you look at, active homes that are able to move in, because obviously the pre-construction to be built, it's not a place that somebody can occupy, for 6 months to a year at this point. So to your point, if we take out the new construction, it's even a lower number. So here's our closed sales. So look at and again, the closed sales, you can see the seasonality, which we kind of missed part of last year. But here's our closed sales. So we're 25% higher on closed sales compared to last February. So, you can, if you want to get rid of seasonality on these charts, you just flip it to a 12-month rolling average. So if I flip to 12-month rolling average, it'll eliminate any seasonality. So, but look at that jump coming out of, so we were on an annual basis. Let's go, beginning of 2020. And again, this is on an annual basis. We're about 18,800 homes sold a year in Charleston. Now we're up to 22,500 or so. And again, these are only the ones in MLS, because we know right now a lot of transactions are happening, not even making it to MLS. Maybe they make it after closing and maybe they never make it, but we know this number is higher than that. But you can see pre-recession, we kind of maxed out about 18,000. So we're above that number at this point. And then at the recession, we got down to 7,500. So we're selling 3 times as many homes as we did, during the recession. So, and then new listings. So here's our, and I'll go back to monthly. So here's our new listings. So we listed in February, we listed 8% less than we did last February. So, here's part of our challenge is we're listing less and have higher demand, which is creating the situation with such a low months of inventory. And you can see the traditional seasonal peaks and valleys, obviously, you know, when you hit December, that's your low on listings. And then when you hit kind of April, May, June, you know, July, that's kind of your peak window. So we're still should be heading towards that, you know, higher listing count hitting the market, but it's being absorbed so quickly. A lot of, I mean, how many houses are coming on to MLS and it just goes active contingent or active close before you even know it's for sale. So, I mean, a lot of that is happening right now, but it's interesting to see the new listing count. We're still not listing as many as we did last year. So pending sales. So we're up 26% compared to last February on pending sales. So when you look at that count where we're at, we're close, you know, we're getting close. We're not quite there, but we're getting close to where we were at the peak of last year, and it's only February. So, you know, I expect us to, you know, obviously surpass that number where we're at over time. And again, we're beating the numbers historically, even in 05 when we, you know, had almost 2,000 pending. We're beating those numbers on a monthly basis. Dollar volume. So come on. So look at February, 47% higher dollar volume compared to last February. So, and you can see the jump coming right into like June, July of last year. Once we kind of got out of the true shutdown period, you can see we were eclipsing, you know, getting close. We hit the billion one month and we're getting close the other months. You know, obviously January was a low month, but then February we picked right back up, $745 million in sales. And I expect us, maybe we're going to hit $1 billion one of these months this year. I mean, maybe June, we might be at that $1 billion mark. So, and you can look for perspective. I mean, even pre-recession, I mean, we were hitting, $500 million was as high as we got. So, I mean, we're double where we were back here. A, house prices are higher. B, there's more transactions. So, all of this reflects back to, agents' commissions, right? So the higher the dollar volume, the more commission there is available. So, I mean, you can see these trends are still, happening. And I wanted to point something out though. So homes for sale. So we were at 1670 at the end of February, and I write on my calendar, and I recommend you guys do this. So I got a wall calendar, or even if you have it on your desk, and I write Monday what the active listing count is. Every Monday I write it, so I can see what the trend is. We were at 2,337 January 1st. So January 1st, we had 2,337 homes for sale. At the end of February, we're down to 1,670. So we've been on a pace of almost losing 100 homes net a week. So it's very interesting, and I can see John on the call here. The last time I checked, we were at 1,688. So I'm watching it very closely this week, because we were at 1,688 on February 22nd. So I'm going to watch it the next week or so, but we might be in this kind of phase of maybe bottoming out, forming a bottom on the inventory. I keep getting fooled every week, and then you come up Monday and the count is lower. But this goes back 2 weeks. We were at 1,688. So I'm going to watch it real closely, but you're seeing these houses hit the market, and yes, they're getting absorbed. But as the inventory starts to hit, it will absorb some of those buyers waiting in the wings. So we need to form, I mean, for the buyer's sake, we need to form a bottom at some point. I mean, this has been a path straight down. I mean, especially if you just zoom into the last, look at this trend. And I mean, this is a national trend. This isn't just Charleston. But I mewe had started that downward slope pre-COVID, and it just, continues that direction. But we really need to watch that active count, because that'll tell us kind of where the market is at. And if interest rates go up, that might slow down the buyer demand, which will in turn lift our inventory, because things won't move quite as fast. They might stay around a little bit longer. So, all of these numbers, and that's why we go over this once a month. It's important to kind of watch what's happening to be able to react when things start to change. But, the stories I'm hearing, I mean, we still have, multiple offers on probably most houses that are listed within days. And if they're not getting multiple offers and they're not getting an offer within 8 days, they're probably overpriced. Anybody, and I wanted to switch gears to more, some of these national numbers, but anybody have any questions or comments on some of these numbers we're looking at? And remember, everybody, you can get into this through Market Monitor, and it's so easy to kind of scroll through and see where it's at. But the reason why I do this once a month is because they update the numbers, at the end of the month. It's not a daily type of program. It's a once a month type of program, but it'll be very interesting to read like news articles and everything, because these prices, if they compare it to a year ago, the next 4 months, this is going to be a big number. I wouldn't be surprised it's 20% or more. And I can show you specific examples of homes that I've seen sell that I think are 20% higher than they sold a year ago, which is hard to believe, but they are out there.
Anton, we have a question in the chat that asks if you'll share your thoughts about interest rates and their projections.
Well, look what's happening in the stock market, especially like this week, and the Treasury bond, that 10-year, if you follow anything outside of this, that 10-year Treasury yield is what to watch. And we are higher than we were pre-COVID. So if you rewind a year ago, our 10-year Treasury yield is higher than we were. So that is the leading indicator of where mortgage rates are. So yes, our mortgage rates historically are, very low. They're not at the lowest at this point, but that, the uncertainty with the stock market that's happening right now, we'll see what happens with that if it settles down. They have job reports grow. So, our unemployment, I think, hit 6.2%. So it keeps going down, and watch all this happens, because what they're going to do at some point, they're going to be worried about inflation. And as that starts to rise, your rates will go up over time. And, I'm sitting here, I can't say you're going to see 2.75, 2.5% again. I'm not convinced that. I think that ship might have sailed. So if your buyers are waiting around, waiting for 2.75, it might be 3.75 before they know it. So, make sure that they understand it's like historically, these are still super low rates. I bought a house in Charleston at 8.25 on an ARM, and I thought that was a good rate. So, it's all relative perspective. Yeah, it's not 2.75, but historically it's still a really good rate. Now, the flip side of it, and I know I've said this before, is that if rates go up, I think that's going to stymie our inventory over time, is that a local seller, for them to go from house A to house B that might be up the street, if they're locked in their house at 2.75% and rates go to 4.25, what's their incentive to move, right? So we're going to lose some of these local seller buyers because they don't want to give up the rate on their house. Somebody moving from Chicago or Boston, they don't have a house here at 2.75. So even if it's 4.25, maybe they'll buy a less expensive house, because if they're buying it off a payment. But from that aspect, it's going to keep the supply low. So I'm not super concerned about where the market's headed from a standpoint of, if rates go up, I believe supply will stay low, even if the demand slows down. But I think this all points to watch the numbers, because this is hard to believe. If we go back, and months of supply is always the number that I always say, that's the one that's the true indicator of where the market is. And it's hard for me to believe that, back, all of us that went through all this period back here, you could see this trend happening right in here, but nobody said there was a problem until here. Right? So like 2008 was the big crash, right? Well, why didn't we say anything for these 2 years before? Now, technology and data has advanced a lot. So I don't think there's going to be a 2-year time lag, but there's probably going to be a 6-month lag between where things start to change and then the general public realizes things change. So that's why I think on a monthly basis, we really need to watch what's happening, so we're prepared to shift our business and deal with our clients ahead of what this happened. Look at this trend here. How did nobody say anything for a 2-year period when all this was happening? Look at our inventory. Look at homes for sale. So our low was in 05. Look at this jump here. And again, this is 06. People are buying houses like they're going out of style, and everybody should have said, uh-oh, we're up to 9,000 listings. We got a problem here. But nobody said anything until we were at the peak. So look, our peak inventory was August of 2007. again, go back and look. When did people say there was a problem? After we had already peaked out on inventory. That's hard for me to believe that that's what happened back then, but look at the data. That's really what happened. So again, I don't think that time lag is going to be as long this time around. So we have to be more, responsive to a change in this. But there's going to be a period of time where we bottom out on inventory, and we got to see how quick we return. Now we are way off from what we need to have a balance. We need 5,500 to 6,000 listings to even get back to close to a balance. So we are a long ways off from that. But watch when the trend starts to change, how quick do we start to return to that? Is it just a slight slope coming up, or is it jumping up? So the difference in the reaction will be how quick we return to a normal. You can see for years here, we're sitting right around 6,000 houses for sale, right? Look at all these years right in here. And then we fell off the cliff here. How quick do we return to that normalcy will affect on how the market reacts. If it's a V and it comes up quickly, then you could have a little bit more of a chaotic return to a normal market, but hopefully it's a slow growth back into it.
Which there's a question in the chat right now that says, what do you think will happen when the foreclosure ban is lifted?
So, and this is, again, my opinion is these people have so much equity in their houses right now. When all the foreclosures happened back here, everybody was upside down on their houses. They might have been negative 10 to 20% equity because A, the banks weren't requiring much down. B, the market fell off in some places 30 or 40%. The difference now is even if you're in a position where you have not made payments and you're in a forbearance and you're fearful of foreclosure, go stick a sign in your yard and sell your house because you have equity in it. So that's a big difference from back here. Yes, our inventory might come up from people doing that, but I don't think it's going to be a rush of what we saw back here, because some people, the last thing they're going to do is let their house go if they have equity in it. Back here, they didn't care. They're like, the bank's not forcing me out. I'm just going to live in this place for free for 2 years. Because I'm so upside down, I don't care about trying to make a payment. It's a different story here. They're going to do everything within their power to borrow money, get a second job, whatever it is, to make that payment because of the equity they have tied in their house. So I'm not, super fearful of the foreclosure market, basically jumping the inventory where we have a problem. Yes, but to some point, we need more houses for sale. Right? I mean, I feel sorry for buyers these days. It's like we need more houses for sale, but I'm not worried about there being a huge rash of foreclosures, because if you can't make your payments, just sell your house.
Yeah.
You have equity in it.
It's like printing cash.
Yeah. I mean, again, it's a different situation than back here. When you have 20% or more equity in your house, you're going to do everything in your power to make payments or get your house sold and get your money out of it. Back here was the exact opposite problem. Nobody had any equity, so they hung on as long as they can, living in a house without making a payment. So those were the big differences. I'm going to flip over. I'm just checking the chat. It's hard for me to see everything. Appraisals. Yeah, you'll love this. Hi, Michelle. So appraisals, and I know that I've had some discussions with agents. It's like, if you're pricing a house, do you have comps within the last 30 or 60 days? Because those are the most relevant ones. And I know it sounds crazy to think a November or December closing might be irrelevant, but in some places it is. So from, yes, there are appraisal issues going on. I had a call from an appraiser the other day who was just asking me in general because, he was struggling with comps. So he is going to start making, and I honestly don't ever remember this happening. He's going to start making time value adjustments. And we had a pretty open discussion about what his time value adjustment is going to be. He's going to adjust the price 1% per month. So I want to put that in perspective. If a house sold for $500,000 in February and he's got a March closing, he's going to adjust it higher by $5,000. So the appraisers are, and again, I'm sure, he probably has to justify with numbers why he's making those adjustments, but you can see where the appraisers are going. They're pulling out the stops to basically, make adjustments, that are legitimately happening, because that's the number that I've been telling people is like, how are house prices not going up 1% a month at this point? That's 12% on an annual basis, but that's pretty much what's happening. I had one house that, yeah, and I see Alan's comment, not all appraisers are doing that, right? So we are going to struggle with appraisals. So you definitely have to watch your seller, and it's like, well, how much are they putting down, and what if it doesn't appraise? So there are more drive-by appraisals, but you do have, and I see Bill's comment. I had a deal that the people knew it didn't appraise, and they still closed on it because they realize what else are they going to buy for that price, and they realize it's still a value to them. So you're going to have a lot of people that will still go to closing even though their house doesn't appraise. But it is an issue that we're going to have to deal with, because if you go back 6 months for comps, those comps, in my opinion, are irrelevant a lot of times because of where the market is at. People are buying houses off of active inventory, and they're comparing the actives. If they're searching at 750,000, what's the best house at 750,000? And who cares what the comp is? What's the best house for them at 750? I did have a question, since we have a few people on here. I had heard through secondhand that Lennar was canceling 110 contracts in Charleston because of their cost versus what they sold the house for. So I don't know if anybody on this call has heard of anybody specific in that situation that they did get it canceled, but just a heads up, these builder contracts, if you read the details, a lot of these can be unilateral cancellations by the builder. And
I had never heard that, but they're offering only 1% co-op now.
Right. Well, and if anybody hears of Lennar doing that, please let me know, because that's what I heard was happening. And again, cost of construction has gone through the roof. So I can see a situation where, their cost to build now might be less, they might be losing money on building a house. I don't feel bad for them. I'm just saying, here's the situation that's happening, is the cost of construction has gone up so quickly.
They're going to start putting cost escalation clauses in their contracts.
Yeah. So it's it's quite a, yeah. And I'm reading Susie, Lennar is not allowing sales in certain neighborhoods right now. That is correct from my understanding too. And so I wrote a contract in Liberty Hill. If people know, that's in Mount Pleasant. So new construction contract, wrote the contract on November 20th. The base price of this house is $120,000 higher. And it is, what's today, March 5th? So this was November 20th of 2020, right? So it's $120,000 higher. And, maybe they were underpriced a little bit, but maybe it's because there's a $60,000 cost to them of construction that they didn't plan on. So, it's being passed on to the consumers. So we have to really watch for inflation down the road, because, you have when you hear about prices doing that, that is a major jump in cost. So at some point you have to watch out for inflation. I'm not trying to scare anybody. I'm just trying to be realistic on kind of where the market is at.
Well, lumber has trebled in price in
Yep.
the last 12 months.
Yep. And I mean, it's going all the way down. I mean, I have a client that does a lot of art dealing, and they package together art and they ship it all over the world. And they're like, it's unbelievable how much it costs us to create something now. And it's specifically because of the wood cost. And so it's not just, house building that's being affected. So it's something to watch. I'm going to flip a new screen here. So this other screen is more of a national. So on a national basis, can everybody see, is the Fred up on the screen, which is the Federal Reserve. Can everybody see that? So what I want to share on here is that if you look at what's happening on a national level, so this is, this is out of St. Louis, but this is the Federal Reserve. So you get some national numbers looking at here. So here's a house price index for the US. So I'll take a second to come up here. So here's house prices. So here's our recession period we went through, our pre-recession run up. So if you look at from basically 2012 to now, it's been a pretty steady rise in house prices. But the slope of this, if you look at the slope of this, it's more than the historical slope if you go back 40 or 50 years. And you can see this run up here, we got caught up with it. So, how long this can last, because obviously we've been in a long period of time of pretty healthy house increase in value. And at the same time, we've been lowering our interest rates. So as they're lowering their rates, they're making the housing more affordable, which is driving up those house prices. Other things on here, and they have a million things on here you can look at. You can go down to states, but I'm just showing you a couple of these big ones. So here's household debt service payments as a percentage of disposable income. So this is what, actually makes me feel a little bit better, is that historically, we are still fairly low as a percentage in the US of what our debt service payment is as per disposable income. And you can see right before the recession happened, we were almost, 13%, and now we're down, 8, 9%. But watch, make sure that this number, and part of this is that, with better borrowing power, it's like less of your disposable income is going towards debt service. So this doesn't make me feel too bad. From historically, we were much worse than that before. And you can see the run up, right? You can see the run up before 2001, the run up here, the consolidation of a lot of debt right in here during the recession. And then you have, so here's existing home sales. So this is, and I don't know why it won't let me go back max on this one, but we are about, on a national basis, we're about 6.6 million sales. And you can see where, when COVID happened, we got down to, when the shutdown happened, we got down to 4 million. Now we're sitting about 6.5, and this is seasonally adjusted. So the US pace is about 6.5 million, which is significantly higher than it was previously. I don't know why this won't let me go back in time, but it must be something wrong with their software. Homeownership rate. So this is something else I thought was interesting, is that historically, so this goes back to 1965. So here's homeownership rate. So we've been between 63 and 69% with homeownership rate for, the last almost, 55 years. So I think this data point here, there's something wrong with it. I think there's a data entry error, because there's no way it jumped that much in 1 month or 1 quarter. So when you look at it, we're sitting, if we take this current month, we're sitting about 66% home ownership. And you can see before the recession, we got up to 69%. And then we fell all the way down to 63%. So, we're kind of in that range that's, again, when I read articles, we're about where we traditionally should be. I don't think we're, so high that it's going to cause an issue, but as, more and more people buy houses, you're getting up to that level where, a third of the people are pretty much renters and 2/3 are homeowners. And that's, traditionally where, you can see here's 50 years of data, and it sits right about the 2/3. So we're right in the middle of, historical, and obviously we're, a little bit higher in here, because remember what interest rates were back here, they were 17, 18%. Now that we're at 3%, you can, have a higher percentage of homeowners, but we're recovering from the recession, right? So this chart doesn't make me feel, too concerned. Rental vacancy rate. So, another thing that drives our housing market is, the rental market. What's the vacancy rate? So look, we're pretty low. We're sitting around 6% vacancy, and historically, again, this goes back to 1956. This is not out of control. We don't have a lot of vacant properties. And that's why you're also seeing rental rates start to go up. You know, rent rates can go up when there's less vacancies. So, I mean, obviously in the recession, I mean, we hit 11%. So we're almost half of where we were at the peak here. So again, this doesn't concern me much, you know, at this point. It's like we're historically fairly low on vacancy rates. You know, you have housing affordability. So I think this one only let me go back a year as well. So this is an index that shows housing affordability. And even as house prices were going up, look at this, why, you know, the affordability was increasing as house prices were going up is because they pushed the rates so low, right? This is where we're going through all the rate reductions, right? So they were pushing rates low and now it's creeping back up. You know, and I wish I could go back further in time. I don't know why it's not letting me do that because I wanted to see historically what the actual, you know, what the usual numbers would be. So again, not too concerning, but like watch, you know, we're losing our affordability and now we're losing our affordability in two ways because you have house prices going up at the same time you have interest rates going up. So, you know, we're getting that double effect of, you know, you're paying more for the house, but you're also paying more on your mortgage. So, you know, we just have to watch that. Here's mortgage debt. Sorry, mortgage debt. So this is specifically based off your house. Now, again, this doesn't make me feel bad. You know, we're only, you know, 3 to 4% of our mortgage debt is as a percentage of disposable income. Again, this is being driven because the rates are so low, but also people are putting a lot of money down. Remember, this back here was because banks were letting people borrow 100%, right? So when you're borrowing 100%, that's a lot more. You're not putting anything down, so you're doing a mortgage debt service. So you're, of course, your rates are going to be higher as far as what your percentage of disposable income. So again, this chart doesn't make me feel bad. Like we're at a low, and this chart goes back. I mean, we're back to 1980. So since 1980, we're still at lows. So that will change over time as interest rates come up, but we're still in a good position on that one. And again, here's median sales price of existing homes. So when we look at this, you know, we're around 310,000. I don't think this one let me go back either. So, you know, on a nationwide basis, you know, we're about 300,000. So Charleston has pretty much now caught the nation on our median sales prices surpassing where the nation is at this point. So we are becoming an above average as an entire, you know, Charleston community. We're becoming an above average price point. So this isn't something I want to share every time. I just wanted to show everybody on a, you know, economic basis. And again, this is a fairly reliable nationwide source. So, you know, there's not as, you know, there's not too many red flags from a housing standpoint that we're not in too much debt. You know, people have equity in their homes. There's not much, there's not many vacancies. So again, you still have to go down to specific areas. My brother-in-law, he lives in Brooklyn, and he just moved to Manhattan on 50th, and he's getting a place for $1,500 a month that he can live by himself for the first time that he's lived there because he can afford it. And it would normally be $2,600 a month. So that specific landlord has dropped the rents from $2,600 to $1,500 just to get it filled. So you can see it's still specific to the area that you're at, but obviously in Charleston, we're in a pretty good place here. So, you know, it's still, you still have to watch the local market. So I'm going to go back to this screen here. So anyway, I just thought, you know, combining our local real estate data with that would be an interesting kind of to see, are we, because I mean, you hear people, are we in this bubble? And I'm like, I just don't feel like we're in the bubble that we were back here because, I mean, think about your buyers right now that you're writing contracts on. A lot of them have a lot of money they're putting down. They have good credit. They have solid jobs. They have savings in case something goes wrong. There's not, for those of us who are in the business back here, everything I just said could possibly be the opposite. And they're primary residence people. They're not, for the most part, they're not investors trying to flip properties. Yes, there's some investors for the long term, trying to find a solid investment rental, but you don't have the flippers were back here. I mean, you have people that had 5 contracts and they weren't going to live in any one of them and they just wanted to make money on them. So we're just in a different environment right now that's not putting up a lot of flags. But I also think learning lessons from what I lived through and a lot of us lived through back here is like, let's watch the numbers on a monthly basis and make sure we understand where the market is headed. I can't see if there's any more chats up there. Let me pull it up. Does anybody have any questions or input?
Write your offer as 20 grand over to hopefully win.
I mean, you have to and again, some buyers are going to have to learn their lesson, so to speak, and maybe lose a house or two. What I recommend for everybody who's showing buyers, let's say you show a buyer a house and they're not even interested in the house, and yet it goes under contract the day, still send it to them and say, hey, remember that house that you weren't interested in? Well, they got multiple offers and over full price and it's already gone. And I see Bill's comment. It's like, yeah, it's like playing the lottery trying to buy a house right now. Back in here, we couldn't find an actual buyer. Now we can't find a seller. So it's a problem for us as agents. It's just a different problem back here. So, from all that perspective, it's like you have to be very straightforward with your clients. And I see Bill here. So there's 492 single family detached homes that have been on the market for less than 60 days. So, the number of choices, I mean, I was looking at something the other day out in Park West, and again, don't go look at MLS today because this was a couple weeks ago. There were 39 properties in MLS in Park West, townhomes, condos, houses. 38 of them had contracts. I mean, it's numbers like that. When I see it, it just blows my mind that that's even possible. Michelle's asking.
The number 39 was a $2 million home.
Yeah. The one that wasn't under contract was a 2.26. Everything else was under contract. I see, Michelle, how high over list price are most winning agents going? I mean, that's such a loaded question because, it's probably, you have probably some houses that are going 10% over, and some might be just going 1% over. And I don't have this verified, but I heard a house in Austin was listed at 450. And I mean, I would love to try to verify this. Listed at 450, it sold at 740. Which
I heard on a webinar in LA, there is escalation clauses that go 10% above the highest.
Yeah. It's phenomenal what's happening. And I mean, you can do your best as a buyer's agent to make a super clean contract and with a quick closing and go over full price, and you still might not get the house. So, your buyers have to, tell your buyers to fall in love with the house once it's under contract, because, don't fall in love in a house and, because if somebody loves a house, well, so does somebody else that's looking at houses. So it's just one of those things that I think we still have some time before it's more of a balanced market where a buyer can actually breathe and think about what they're doing. I also know that, when I'm representing my sellers and I have multiple offers, I will guide them to okay, well, if some of these are virtual where there's a FaceTime walkthrough versus somebody who's actually walked through the house, the preference would be somebody who's actually walked through the house and hears what's going on and can smell the house and all that other stuff, because a lot of these out-of-towners are trying to buy houses from remotely, but some of them get here and it's just not what they expected. So, those more solid contracts will be somebody who's physically walked through the house in person rather than having an agent FaceTime it to them. And I know you have to do anything possible when you're from out of town, but I don't feel like those contracts are necessarily as strong compared to somebody who's walked through it. Yeah, Joanne, I see your comment. There's 4 in Park West today. How many homes are in Park West? A couple thousand. There's 4 for sale. and then I see Sean saying, I've had 2 agents in the past 4 days tell me they're not taking unseen offers. Yeah, and Michelle as well. So it's just be very careful. And Bill's comment about due diligence, like if I'm representing as a seller, why are we in due diligence? You know, yes, there are specific circumstances where due diligence still matters these days. But if you're representing a buyer and they really want the house and you write a due diligence contract, you're probably not getting it. So, you know, you have to explain to them the difference between the due diligence and I mean, I wrote one last week with an as is. You know, we kind of understand a lot about the property. I don't usually recommend that, but we kind of understand the property. It's a condo. We know what's going on. There's no, you know, there's nothing that's so to win the house, we wrote it as is. And so, you know, you definitely have to guide your buyers so they understand the difference between due diligence and repair addendum. And you also have to guide your sellers, you know, what the difference is there. You know, there's a big difference. And, you know, one thing you have to watch out for in this market is that you're going to get a seller under contract, and that seller at some point is going to realize maybe they undersold the house because they're going to hear about other properties or they're going to see something listed higher. So I definitely think you have to be very careful of meeting those closing dates. And just as an example, if you have a closing date of March 15th and March 16th rolls around and you don't have it closed, that seller doesn't have to sell that house if there's no extension on there. So I almost recommend, you know, and I don't know if Joseph's on the call, but make sure if you need to close a few days before, schedule the closing a few days before the date, and make sure that you're not leaving it up to an hour or two to get this thing closed, because if that seller thinks they undersold the house, they might just pass on, you know, if you miss that closing date, they don't have to close on it.
I talked to a buddy who has a home on Folly Beach under contract, and he's got a backup offer, or the agent does $100,000 over his offer. So the moment something comes up, they're not going to, they're going to go with the other offer quickly.
Yep. So some sellers are going to do their best to get out of the contract if they realize they undersold the house. So, you know, we're in very interesting times right now that you have to be, as an agent, very diligent at your process and making sure you're meeting all the steps on the guidelines you have, and don't leave it up to an hour or two to get a property closed. It's like, close it early if you have to, and work it out with the contract. So, you know, another avenue is that you might have some buyers worried about, you know, paying so high and striking appraisal contingencies that they can't come up with the extra down payment. Well, you know, you can make an offer at a price, and I'm just going to throw out numbers. Let's say you made an offer at 550. Well, you can also add the clause in there, the appraisal clause, just say, well, as long as it appraises for 525. So you're limiting your exposure, saying, hey, I'll pay, you know, my contract for 550 as long as it appraises for 525. So if it comes back at 475, you're not having to come up with $75,000. You still have a escape hatch on the bottom. So we have to become, you really have to think through things and become creative right now to win deals, but also protect your clients at the same time. And I know I'm glad to see everybody on the call today. Are there does anybody else want to contribute any situations that they've seen that might help other agents?
All price points I'm in multiple offers in a lot of different price points, lower end, higher end. It doesn't seem to matter at all.
Yep.
So
I agree. It's across the board. And you know, I know that, you know, downtown's had some challenges here in the last few years, but I mean, I can even see those properties, you know, you watch, those properties are moving now. And I'm not saying it's as strong as the rest of the market, but it is definitely improving down there. And you see things going under contract. So
yeah, I've got one client in a price range, and we're looking, I'll just be under 300. He's approved for 300. He's got a gift from the parents to go over 300 with the difference in cash. And every offer we're making is at his top of his purchase price. So if it's 275, we're offering 300, and we've lost out on 2 homes so far doing that strategy.
So, and I mean, you can tell with these, I mean,
Crazy.
if you looked at the, the sales, the percent of original list price, I'll be anxious to see next month, because I don't know if the glitch is still in their software, if you can't go above 100, but if it's 100 next month, I'm kind of assuming we're above 100 and their software is just not able to do that. So, it sounds strange, but I mean, you can push a limit on a price of a house and then still get over full price on it.
Anton, can you do that for resales only?
Yes. So we're at 98.8 on resales, and then let's see if new construction bumps over it. No, see, there must be something. Yeah, there's definitely something not keeping up with their software, and it caps it at 100.
Well,
So.
New construction, they always put the price at the sales price, so that's why.
But sometimes if it's under contract and they put upgrades in, then they go over it.
Yeah, but then they put it in the MLS and they correct the list price.
Okay. So, again, even on the resales, we're getting close to 100%. So it's certainly interesting times, and we're all learning from this. And again, even back, I was in the business back here, it wasn't even like this today. I mean, this is a new world for real estate we're living in that wasn't even this crazy back here. So, you're having to adapt and learn and make changes on the fly and be very responsive on, when houses come on the market, you have to be all over it. So, here's Sean. Oh, can anyone suggest how to get your client in a home today when the seller doesn't want to show it until Sunday? Again, there was a property that came on the market and it had all the times blocked and it still went under contract. So, I mean, it's happening that either people are just buying sight unseen and, sellers and listing agents are accepting that, or, somehow they snuck in the back door. It's like, you got to have a good relationship with those other agents to try to get your client in before the seller has said yes. And I mean, a lot of agents up front are saying, hey, we're going to have showings for these 2 days and we're going to do best and final on this day and time. And they already are assuming up front they're having multiple offers.
But I did with a lower price vacant one, we said sellers will look at offers after Sunday at 4 p.m.
Yep.
And we gave a week for everyone to have at it, send offers, do their due diligence. And that worked really well. We had, obviously many offers and we sold for a lot more than list price.
Yeah. And I mean, to Michelle's point is I think you could probably tell 3 people in Mount Pleasant or wherever you're selling a house, you could probably tell 3 people and somebody knows somebody that wants to buy that house. So to her point is social media is driving this, that between next door and the neighborhood, people can put, hey, I'm going to sell my house. And then they might have 3 people that they instantly know. So we really have to be conscientious of where social media is, entering our world from a standpoint of there's so little inventory and so much demand. You can mention your house sale to a couple people and you might just sell it. Obviously the buyers, that are just, unrepresented, or, the financing falls through, or they just change their mind, or, maybe they got too excited. So you still have to show your value to your buyers and sellers at this point more than ever. Bill Bird, how much of lack of inventory do you think is due to sellers not wanting to be exposed? I don't think the COVID thing is like much anymore. I think the bigger problem with the lack of inventory is sellers don't know where to go. If I put my house up for sale, where am I going to go? And the problem is that you can't write a contingent upon selling because nobody's taking that, right? Who's going to take that these days? Nope. So the sellers are like, I mean, I've had some sellers that who want to be buyers, but they pretty much gave up. They're like, you know what, we're just going to stay put because, the prices are at a level and the competition is the level. We don't want to put our house up for sale, get it under contract, and not have any idea where we're going. And you might have some leverage, bridge loans. I'd have to ask. I don't know who's doing bridge loans right now. But from you might be able to. There's so little
Meg
supply.
Rob is doing bridge loans.
Pardon me?
Meg Rob.
Okay.
doing bridge loans?
You might be in a situation with a seller, if they don't know where they're going, there's so little supply, you might be able to tell a buyer, hey, the seller needs a 30-day contingency to be able to find a house. So you might be able to do that, is that you because the buyer maybe can't find anything else, they're willing to hope and wait 30 days, for them to find a house. So we might be going the opposite, and the seller wants a contingency to find a house. And again, people who, I know the prices of the houses, you would think, wow, look at what I can get for my house. But imagine the people who said that in August and September of last year, what they're thinking today. What are they thinking? Probably that they made a huge mistake, right? So be very careful with, your sellers kind of assuming this is like a peak market. I'm not necessarily convinced it is until we start to unwind some of this, over demand and under supply that we're in. And I think this is where we're living this year for sure, is that we have multiple buyers for every house that comes on the market. So, well, I hope this was informative. I appreciate everybody's, input and sharing, because we got to work together right now and figure out kind of solutions to everybody's problems. And the problem is lack of inventory. But feel free to the next time. So we'll do this the first Friday of every month, and I'll try to bring in some more input and some other numbers to share. But we want to, and again, this is almost forced. It's like I'm going to show this chart every month and go through it, because that forces all of us to look at it and realize what's going on. So, but hope everybody has a good weekend out there, and good luck in finding a house for your buyer. I'm not wishing luck for any of the listing agents, because your house is already sold. So, so anyway, everybody have a great weekend.